Good day, ladies and gentlemen. Welcome to my channel. Today is October 15th, 2022, and I'm going to discuss gold, dollar, and US bond market. Gold is back under a 2.5-year horizontal support, following a nice rally early in October. The weekly close suggests that the metal is once again at a vulnerable position. But we have to remember that the bottoming is a process, which is specifically engineered not to give a comfort. In the medium term, it is still trading with an 8-month descending channel. In the grand scheme, nothing extraordinary happened over the passing week. But as per weekly closing price, I am turning from bullish to neutral once again. Let's have a look at the dollar index for further clues. This is a 15-year major rising channel, which I discussed in the last video. As you can see, dollar is trading just under the upper band of the channel. It takes several weeks before it tops. It has been almost 3 weeks that the index has been stuck at around $113, $114 level. Presently, dollar is trying to get some clues from the upcoming FOMC meeting, which is scheduled for November 2nd. So the index may stay undecided for another 1 or 2 weeks. My expectation is that Federal Reserve will likely go for a smaller rate hike, such as 25 or 50 basis points. And this could indicate that Fed is pretty much done with rate hiking. If so, dollar might start a correction, at least in the short to medium term. I believe Fed might largely be done with rate hiking due to a dire situation within the US bond market. This is a long-term chart of a US 30-year bond yields. As you can see, yields more than tripled from a little over 1% to almost 4% in less than 2 years. Spike in the rates drove the long-term US bond market over the cliff. Let's switch charts. This is a US 30-year Treasury bond market, which has been in a bull run until recently over the past 40 years. Last month, a 40-year trend line was legitimately broken, which is an extremely important price action. We are living in unprecedented times that happens once in a life, and which is why it is getting so difficult to understand and forecast markets. Further breakdown of the US Treasury market could create a chaos across the entire global financial markets that would make recent inflationary problem nothing compared to it. As bond prices collapse in price, US bondholders are trying to get rid of it as quickly as possible. Selling pressure pushes rates higher and bond values lower. Fed pushing rate hiking narrative means that bonds will further lose in value, motivating sellers to act more aggressively. If selling pressure increases and there are no sufficient buyers, then who is going to provide liquidity? Even US Secretary of Treasury Yellen raised the flag, suggesting that the bond market is experiencing a liquidity problem. And all of this happening at a time when US national debt reached 31 trillion US dollars last week. At present interest rates, servicing national debt probably costs nearly 1 trillion annually and will keep rising over the time. So the Federal Reserve is really cornered and has to choose whether it is going to save US Treasury market or fight with inflation. Further aggressive rate hikes mean further loss of liquidity in the bond market and higher cost of servicing the national debt, which would ultimately force Federal Reserve to start an even aggressive QE. Alternatively, taking a pause with rate hiking could send a positive signal to bondholders, restoring liquidity in the bond market. Also, it would likely trigger a sell-off in the dollar, as Federal Reserve abandons the fight with inflation. Ultimately, it means that gold should soar in price. The end game is clear. Either Federal Reserve gives up on inflation fight now, which sends gold $600 to $700 higher from present levels, or it keeps pushing rates higher and collapses US bond market, which ultimately means even larger QE, collapse in the dollar value and gold to the moon. So let's be patient and wait for the clues over the coming days. In any case, by November 2nd, if not before, everything would be clear and cut. This is it for today. Stay well and enjoy the weekend. Please note that this video is not an investment advice and prepared solely for educational purposes.